Warren Buffett, one of the most successful investors of all time, once declared The Intelligent Investor to be by far the best book on investing ever written. With such high praise from the legendary investor, it's no wonder that this timeless classic is the stock market's Bible ever since its original publication in 1949. Authored by Benjamin Graham, the father of value investing, The Intelligent Investor transcends generations. It is by far the most important book you will ever read on how to reach your financial goals. In this book, Graham lays out a philosophy that emphasizes rationality, discipline, and patience in the pursuit of financial success. In this video, you'll discover the importance of disregarding market fluctuations, the benefits of a structured approach to investing, and the fundamental principles of an intelligent investor. Understanding stock market history as a cornerstone of investment strategy. Before delving into individual stock histories, it's imperative to grasp the broader context provided by the market's past performance. Reflecting on historical trends reveals the inherent cyclicality of the stock market, characterized by periodic fluctuations that defy precise prediction. This unpredictability underscores the necessity for investors to prepare themselves both financially and mentally for the inevitable ebbs and flows of the market. Economic upheavals, such as the infamous Wall Street crash of 1929, serve as stark reminders of the market's susceptibility to crises. Thus, prudent investors prioritize building resilient portfolios capable of weathering significant downturns by diversifying their holdings. Additionally, cultivating psychological resilience is essential, as knee-jerk reactions to market turbulence can often exacerbate losses. Despite the inevitability of market downturns, history also demonstrates the market's remarkable resilience and capacity for recovery. By maintaining a long-term perspective and resisting the urge to hastily liquidate investments during turbulent times, investors can capitalize on the market's eventual rebound. Moreover, a thorough examination of a company's historical performance is crucial for informed investment decisions. Analyzing factors such as earnings, dividends, and stock price trends over a significant time frame offers valuable insights into the company's stability and growth potential. Adjusting for inflation further refines the assessment, providing a realistic depiction of the actual returns on investment. In essence, a deep understanding of stock market history serves as a potent tool for astute investors, empowering them to make informed decisions and navigate the complexities of the market with confidence. 3 fundamental principles of intelligent investors. Firstly, intelligent investors meticulously evaluate the long-term growth prospects and fundamental business practices of prospective companies before committing to any stock purchases. Recognizing that a stock's enduring value hinges upon the company's performance, investors should scrutinize key factors such as its financial stability, management quality, and consistent dividend payouts, rather than solely fixating on short-term earnings. By examining a company's financial history, investors gain insights into its intrinsic worth independent of market fluctuations. For instance, a company with a modest current market valuation but a track record of sustained profitability may represent an undervalued investment opportunity. Secondly, intelligent investors safeguard against substantial losses by diversifying their investment portfolios. Recognizing the peril of placing all assets into a single stock, investors spread their investments across a range of assets. This strategy mitigates the risk inherent in individual stocks, shielding investors from catastrophic losses should any one investment falter unexpectedly. By diversifying, investors mitigate the risk of total loss in the event of adverse developments, such as corporate scandals or market downturns. Lastly, intelligent investors prioritize the pursuit of consistent and secure returns over the allure of extraordinary profits. Understanding that attempting to outperform professional traders or chasing rapid financial gains often leads to imprudent decision-making, instead, investors should focus on meeting their personal financial objectives. By eschewing the temptation of quick riches and adopting a disciplined, patient approach, investors cultivate a mindset conducive to long-term financial stability and success. Prioritize a methodical approach over impulsive actions. Investing offers significant opportunities for wealth accumulation, as exemplified by successful investors like Warren Buffett, who have reaped substantial rewards by selecting the right companies. However, alongside these triumphs, financial history also documents numerous instances of devastating losses incurred by those who made misguided investment decisions. This prompts the fundamental question: is the potential reward of investing worth the inherent risks? The resounding answer is yes, but with a caveat: adhering to the principles of intelligent investing. Unlike speculators who chase short-term gains driven by market fluctuations, intelligent investors rely on thorough analysis to secure consistent and safe returns. Speculative ventures, characterized by their inherent unpredictability, pose substantial risks due to the inability to foresee future market movements. For instance, a speculator might act upon a rumor of an impending successful product launch by a company like Apple, gambling on the stock's rise. While this strategy could yield profits, it equally holds the potential for substantial losses if the rumor proves unfounded. Conversely, intelligent investors focus on the concept of intrinsic value, purchasing stocks only when their price falls below their true worth relative to the company's growth prospects. Operating with a margin of safety, akin to discerning consumers seeking value in purchases, intelligent investors ensure that the potential returns outweigh the initial investment. The path of the intelligent investor may lack the thrill of speculative ventures, but its primary objective lies in securing profits through prudent decision-making. Do not follow the market or the crowd. To comprehend the unpredictable nature of the market, it can be helpful to conceptualize it as an individual named Mr. Market. This fictional persona is characterized by unpredictability, moodiness, and a lack of astuteness. Mr. Market's susceptibility to external influences manifests in significant fluctuations, swinging between periods of unwarranted optimism and unjustified pessimism. For instance, during the release of a highly anticipated product like the iPhone, market enthusiasm often leads to inflated prices as investors rush to capitalize on perceived opportunities. Consequently, when the market exhibits excessive optimism, stock prices become overvalued, posing a risk to investors. Conversely, periods of undue pessimism may prompt unwarranted sell-offs, creating opportunities for astute investors. Intelligent investors eschew the herd mentality and refrain from succumbing to Mr. Market's mood swings. Instead, they adopt a realistic outlook and maintain a disciplined approach to investment decisions. Furthermore, investors must remain vigilant against the allure of short-term gains, recognizing that past profitability does not guarantee future success. Despite this awareness, human psychology predisposes individuals to seek patterns and extrapolate future trends based on recent performance, even in the absence of concrete evidence. Understanding these fundamental principles of intelligent investing lays the groundwork for informed decision-making. The defensive investor's portfolio should prioritize balance, safety, and ease of management. When embarking on your investment journey, it's crucial to select a strategy that aligns with your individual preferences and risk tolerance. One of the primary paths to consider is that of the defensive investor. The defensive investor harbors a strong aversion to risk and places paramount importance on safety. Achieving this safety requires diligent diversification of investments. First and foremost, the defensive investor should allocate funds to both high-grade bonds, such as AAA government debt securities, and common stocks, which grant ownership stakes in companies and voting power in major business decisions. A balanced approach typically entails a 50-50 split between bonds and stocks, though risk-averse investors may opt for a ratio of 75% bonds to 25% stocks. Recognizing that bonds offer greater security but lower returns compared to stocks, this diversified approach accounts for varying levels of risk and potential profitability. Furthermore, within the common stock portfolio, diversification remains key. Investing in established, reputable companies with proven track records of success is advisable, with a minimum of 10 different companies to mitigate risk. While this level of diversification may seem daunting, simplifying the decision-making process is achievable through the principle of simplicity and choice. Rather than reinventing the wheel, defensive investors can emulate the portfolios of reputable investment funds with established track records of success. This approach avoids chasing trends and instead focuses on aligning with proven strategies. Lastly, engaging the services of a knowledgeable expert is recommended to navigate the complexities of investing effectively. Their expertise can offer valuable guidance in making sound investment decisions. Investing becomes straightforward when you adhere to a structured approach. Once you've selected the companies for investment, congratulate yourself on completing the bulk of the work. Now, your focus shifts to determining the regular investment amount and periodically reviewing your portfolio. Enter the realm of formula investing, where you strictly adhere to a predetermined formula dictating the frequency and amount of investment. This method, also known as dollar-cost averaging, entails consistent investment in a chosen stock at regular intervals, maintaining uniform investment amounts. After identifying a secure and promising stock, set your investments on autopilot by committing to a fixed amount, say $50, to be invested at regular intervals. This ensures a disciplined approach and guards against impulsive decisions. The advantage lies in the simplicity and discipline of formula investing, where you avoid overinvestment and speculative behavior. However, emotional challenges may arise, as adhering strictly to the predetermined formula limits flexibility. Defensive investors should periodically review their investment portfolios to ensure continued efficacy. A rule of thumb is to reassess the allocation between common stocks and bonds every 6 months, ensuring profitability and maintaining the desired balance. Seeking professional advice annually to fine-tune investment strategies is prudent, ensuring alignment with long-term financial goals. By following these guidelines, investors can navigate the complexities of investing with confidence and discipline. You can buy the best book on investing ever written on Amazon for under $18. Please see the link in the description. And please take a second to subscribe to our channel. It's free and helps us to create content like this. Alright, back to the video. Enterprising investors embark on their investment journey with a strategy akin to that of defensive investors. To attain success as an enterprising investor, adopting many of the same principles as defensive investors is crucial. Similar to defensive investors, enterprising investors allocate their funds between bonds and common stocks. While defensive investors typically maintain a balanced 50-50 split between stocks and bonds, enterprising investors lean more towards common stocks due to their potential for higher returns, albeit with increased risk. Like their defensive counterparts, enterprising investors also seek guidance from financial planners. However, the relationship between the enterprising investor and their financial planner differs. Rather than viewing the planner as a mere instructor, the enterprising investor sees them as a collaborative partner in managing their finances, making decisions together. In addition to bonds and common stocks, enterprising investors explore other types of stocks with higher risk and reward potential. This may include emerging startups perceived as high-growth opportunities, albeit with limited investment amounts to mitigate risk. Despite the allure of promising investment opportunities, enterprising investors exercise caution by limiting such speculative stocks to a maximum of 10% of their overall portfolio. This prudent approach serves as a safeguard against the unpredictability of the market and economic downturns. Furthermore, like defensive investors, enterprising investors recognize the importance of ongoing research and monitoring to ensure the continued profitability of their portfolios. By remaining vigilant and adaptable, enterprising investors navigate the dynamic landscape of investing with resilience and foresight. The enterprising investor adopts a steadfast approach amidst market fluctuations. When confronted with declining stock prices, the immediate instinct of many investors is to sell in fear of potential losses. Conversely, witnessing the surge of another stock may prompt hasty decisions to jump on the bandwagon. This reactionary behavior, termed trading in the market, is common among investors driven by the fear of missing out on potential gains. However, the astute enterprising investor understands the folly of such actions. Relying on Mr. Market's erratic behavior is deemed perilous by enterprising investors. A rapid rise in stock prices often signals either inflated valuations or risky investment propositions. The cautionary tale of the U.S. housing bubble serves as a poignant reminder of the dangers of disregarding intrinsic value. In the midst of soaring prices, few recognized the disconnect between market prices and underlying fundamentals until it was too late, resulting in a catastrophic market crash. To circumvent such pitfalls, enterprising investors adopt a contrarian approach, buying into undervalued markets and selling in overvalued ones. Regular portfolio assessments are essential, focusing on factors such as management effectiveness and financial health. If a company's stock prices soar disproportionately to its intrinsic value, prompt divestment is advised to mitigate potential losses. Conversely, opportunities abound in low markets, as exemplified by Warren Buffett's investment of Goldman Sachs in the midst of 2008 financial crisis turmoil at rock-bottom bargain prices. By adhering to a disciplined approach that ignores the market hype and focuses on fundamental analysis, enterprising investors navigate market fluctuations with resilience and foresight. The enterprising investor hunts for valuable bargains. Becoming an enterprising investor may now seem like an exciting challenge. However, one might wonder if the effort of continually monitoring your portfolio is truly worthwhile. In fact, it is, as this is where the most lucrative opportunities lie, but only if approached strategically. To commence your journey as an enterprising investor, it is advisable to start by virtually tracking and selecting stocks. Investing virtually for a year allows for the refinement of your ability to identify bargains and monitor stock progress. Numerous websites now offer platforms for virtual investments, enabling you to gauge your performance against market benchmarks. This one-year practice period serves multiple purposes. Not only does it enhance your understanding of investment intricacies, but it also helps temper unrealistic expectations. Once you've completed this virtual experience, you'll be well equipped for bargain hunting. The prime hunting ground for bargains is often in undervalued stocks of companies facing temporary setbacks or unfavorable market sentiment. However, identifying such bargains requires skill and practice. Hence, it's crucial to hone your abilities through virtual experience first. If you can succeed in the virtual realm, you can certainly succeed in real-life investing. Final takeaway. Whether you opt for a conservative approach or embrace a more entrepreneurial mindset, it's essential to tread the path of the intelligent investor when it comes to stocks. By adhering to the principles outlined in this book, you can transform your investments into consistent and secure profits.
If you like this video, you are going to love this one about the book Die with Zero. It's about getting all you can from your money in your life, and how to die without regrets and without your hard-earned money being spent by other people.